Question 26, Chithurst. This question is about dividend policy, dividend payout ratios, dividend policy. So it's all about dividend. Okay, and we are going to go through the requirements. There are two requirements. Part A, discuss the benefits and drawbacks of dividend policies which the three companies appear to have adopted. Provide relevant calculations to support your discussions. So this tells you that you also need to do discussions. Up to 5 marks are available for calculations. So that shows that 10 marks is for benefits and drawbacks. So benefit and drawbacks of dividend policies for three companies. And 5 marks for calculations. B, discuss how market capitalization of the three companies compare with your valuations calculated using the dividend valuation model. So it tells you which model you have to use to value. Okay, to value the company, you can also use dividend valuation model. Discuss how the market capitalization of the three companies compare with the valuation calculated. Use the data provided to calculate valuations based on the growth rate for the most recent year and for the last 3 years. The hint is here. They have clearly told you what you have to do. So you have to use the growth rate for the recent year and for the last 3 years. Up to 5 marks for calculations. Again 5 marks. So 5 marks for calculations, 5 marks for discussing. Okay. Now, Chithurst gained a stock exchange listing 5 years ago. At the time of the listing, members of the family who founded the company owned 75% of the shares, but now they are just hold over 50%. Number of shares and issue has remained unchanged since Chithurst was listed. Chithurst company directors have continued the policy of paying a constant dividend per share each year the company had before it was listed. However, investors who are not family members, okay, have become increasingly critical of this policy, saying that there is no clear rationale for it. They would prefer to see steady dividend growth, reflecting the increase in profitability of Chithurst since its listing. The finance rate of Chithurst has provided is both with details of Chithurst dividend and investment expenditure. Compared with two other similar sized companies in the same sector, Eartham and Epping, each company has a 31st December year end. So you can see the three companies has been given, right? You can compare. We have been given for 2002, 3, 4 and 5 for the 4 years. Profit for the year after interest and tax, dividend paid, no investment expenditure for all the three companies. Next, other financial information relating to the three companies. You can see the cost of equity, market capitalization, right? So this market capitalization you have to compare with the value you get after using the dividend valuation model. Okay, that's what was there in part B. Okay, so coming to increase in share price in last 12 months, and Chithurst company's finance details estimated the cost of equity for all the three companies. None of the three companies has taken out a significant new debt finance since 2001. Okay, so now benefits and drawbacks of dividend policies. You have to do some calculations. Okay, it's from here. So let's see how the answer has started. Okay, marking scheme I will show you later. So first, whenever it is there, dividend, whenever this question is there for you to compare the dividend method for the three companies, start with dividend payout ratio. Okay, for the 4 years, 2002, 3, 4 and 5, for all the three companies, make sure it is in a table form like this, so it's easier for you to compare, and all the sign percentage. Okay, so let's start with the Chithurst. What is the dividend payout ratio? If you are seeing for the Chithurst, it says 42.9, right? How is it 42.9? It is simply, the formula is this. Here they didn't write the formula, they didn't show you how you got that dividend. It is dividend paid divided by profit after interest and tax. Okay, I will write here. Profit after tax, after interest and tax. So dividend paid divided by PAT is a dividend payout ratio. So for 2002, just see here, this is 33 dividend paid. For Chithurst, divided by profit after tax, which is 77. So 33 divided by 77, if you are getting 42.8 something, round up to one decimal place, 42.9. Okay, so likewise you should be able to calculate for the others also. Okay, I just calculated for this 42.9. Likewise you have to calculate for others, and here you can see it's a negative. It is negative. Why? For 2003. Okay, we'll go to other because this is not a profit, it's a loss. Okay, now let's go to the next one, because they told calculations, relevant calculation. They didn't tell you which all calculations you have to do. You have to do all the calculation which is related to dividend. So residual profit, profit after tax for the year minus dividend minus reinvestment. This is the formula they have given you for the residual property. Profit after tax for the year minus dividend minus. We'll see how we got this 26. Likewise, you shall be able to calculate for others also. Okay. Profit after tax for the year, which is 77. Okay. 77 minus dividend is 33, and investment expenditure I can see here 18 for Chithurst. Okay. So it will be 77 minus 33 minus 11. It will be 33. Wait, no. It's not 11. It is 18. I'm sorry. This is 18. So you are getting 26. Likewise, you have to get for all the others. Formulas given there. Now coming to Chithurst policy, you have to tell benefits and drawbacks. For each company, you have to talk about their policy, benefits, drawbacks. If you see like this, for them we have given, right? And for IPing also we have benefits and drawbacks, and it's quite long. It's quite long. So what I'm going to do is I'm going to quickly go through it, okay, without wasting so much of your valuable time. Starting with Chithurst company's policy. Likewise, you have to write the name as a subheading, then benefit, then drawback. Okay. So let's go to their payout ratio. For Chithurst, just see for Chithurst 2002 to 5 what's happening: 42.9, 41.3, 35.1, 34 point. It is keeping on reducing, but that change is not so much, very small amount. Now let's go to the residual profit. Residual profit, if you see 26, then 18, then 38, then 43, it's keep on increasing it. Okay, so the benefit. Chithurst company's policies provide shareholders with a stable, predictable income each year. Yes, it's a stable and it's predictable income each year. That is true. Income is increasing, dividend, even though it's reducing, the change is very small. More or less, it's stable. As profit have grown consistently, dividend cover is increased, which suggests that for now, dividend levels are sustainable. These are positive signals to the stock market. Okay. Now, coming to the drawback. Chithurst's dividend policy is unpopular with some of its shareholders. They have indicated a preference for dividend levels to bear a greater relation to profit levels. They have told that higher the profit, higher the dividend. But that's why this is, you can see dividend is reducing but profit is increasing. So it is unpopular, although they are still in a minority. But the one who is not with this, they told that profit has to increase, also dividend, they are the minority shareholders. So although they are still in minority and cannot force the directors to pay more dividends, they are now possibly a significant minority. Ultimately, Chris, share price could fall significantly if enough shareholders sell their shares because they dislike the dividend policy. Yes, if the shareholders are not happy with dividend policy, they can sell it. They can sell their shares. When the shareholders sell their shares, the share price could fall for this company. Okay, Chithurst. So the dividend policy may also have been established to meet the financial needs of the shareholders when Chithurst was unquoted. Could be. Right? They were unquoted before. So maybe this dividend policy was established then to meet the financial needs of the shareholders. However, it is now. You have to talk about then and now. Now they are listed. It is now difficult to see how it fits into Chithurst's overall financial strategy. Greater proportion of funds retained does not appear. So less dividend is reducing means what? They are now retaining more. That's why they're talking about retaining. The greater proportion of funds retained does not appear to be linked to the levels of investment Chithurst is undertaking. See, when some companies having a greater retention, they are retaining. They are not paying dividend. That means they are going to invest it in new investments. Let's go and check their new investments. Chithurst from here. If you say their investment, okay, 18, 29, 23, 21. It increased from 2002 to 3, but then it kept reducing. So your retention is not leading to any new investment expenditure. That's what they're saying here. The great proportion of funds does not appear to be linked. It is not linked to the level of investment. Chithurst shareholders may be concerned because it is not linked with the new investment. It is very common that they will be concerned that the best use is not being made of the funds available. Yes, they're having the fund available, but they're not making the best use of it. If there are profitable investments which Chithurst could be making, but it is not doing so, then Chithurst may find it more difficult in future to sustain the level of profit growth. Alternatively, profitable investments do not exist. Some shareholders may prefer to have funds retained in a form of a special dividend or share repurchase. Now coming to Eartham. Okay, before we talk about benefit or drawback, we'll just go through the table and see what's happening to Eartham. Okay, 40% then it is making a loss, so dividend payout is in loss. Basically, no dividend payout in that year, 2003. Then 2004, 40, 50, it is same only. No change, no increase. Coming to residual property, if you see 27, then it's a loss, then 24, then 43. So it is increasing from 2005. And also we'll see, since the dividend is, if you see, it is same, and we'll see the investment also. Okay, new investment expenditure for Eartham. It is 30, 15, 42, 29, reducing. Okay, so now we can talk about benefits. For 3 out of 4 years, we saw Eartham has been paying out dividends at a stable payout ratio. This may be attractive to some. See, since it's stable, it might be attractive to some investors who have expectations that the company's profit will keep increasing in the long term and wish to share directly and increase its profit. The year when Eartham's dividend payout ratio differed from the others was 2003. Mention about this. Whenever there's a very large difference, always mention this. Because in 2003, you saw it was huge, 115. So when Eartham made a loss, that was the year you have to mention about it. A dividend of 15 million was paid in 2003, which may be a guaranteed minimum. This limits the downside risk of dividend payout ratio policy to shareholders, as they know they will receive this minimum amount in such a year. Coming to drawbacks. Wow, the drawbacks look, so many drawbacks are here. Although shareholders are guaranteed a minimum dividend each year, dividends have been variable. Eartham shareholders may prefer dividends to increase at a steady rate. It's not increasing, which is sustainable over time, even if this rate is lower than the rate of increase in some years under the current policy. If Eartham had another poor year of trading like 2003, shareholders' expectations that they will be paid a minimum dividend may mean that cash has to be earmarked to pay the minimum dividend rather than for offer may be better used in the business. That means they have to pay the cash. Maybe that cash could be used in somewhere else, but they cannot use it for them to pay that minimum dividend if a loss like in 2003 occurs in future. Having a normal dividend payout policy results in expectations about what level of dividend will be. Over time, Eartham managers may be reluctant to change to a lower. Yes, see, once you are paying a high payout ratio, and later if you want to change to a lower payout ratio, manager might resist. They might not want it because they fear that this will give shareholders an adverse signal. Yes, if your dividend payout ratio reduces, it gives an adverse signal to the shareholder. Even if its directors maintain a constant ratio normally, shareholders may question whether the proportion of funds being retained is appropriate or whether a higher proportion could be paid out as dividends. Eartham appears to be linking investment and dividend policy by its normal policy of allocating a constant proportion of funds for dividends and therefore constant proportion of funds to invest. However, the actual level of new investors does not seem to bear much relation to the proportion of funds put aside for investment. As you can see, it is not being, investment is reducing. So when deciding on investments, the director would also take into account the need to take advantage of opportunities as they arise. And overall amount of surplus funds build up over the years together with other sources of external finance available. This could be various points. Maybe your points could be different. You will be getting marks for it. Coming to IPPing. Okay, for IPPing, before we go benefits and drawbacks, let's see what's happening. The dividend payout ratio, if you see, it is reducing. 46.7 to 19.3, such a big reduction. This you need to mention. In 2003, this one. Then it increased for 33.1. Again, it reduced to 31.8. It's very unpredictable if you see. Increasing, decreasing, increasing, decreasing. And when you go to residual property, 3746. It's not so good. Let's go to the investment. Okay, expenditure, if you see 37, 64, 75, 84, it is increasing. Yes, it is increasing. That's why maybe their dividend payout ratio is reducing, because they want to retain and invest. Okay, so now let's talk about it. Benefits. Aping seems to have adopted a residual dividend policy. Yes, it's a residual dividend. It is known as residual dividend policy, which links investment and dividend decisions. We saw that investment increasing, that's why their dividend is reducing. So the strategy appears to make investments to make investments if they offer sufficient return to increase long-term company value, and only pay dividends if they are no more profitable investments. Okay. So they are only making investments if that investment offer them a sufficient return to increase the long-term company value, and only pay dividends if there are no more profitable investments. They are assuming that internal funds are cheaper than external funds, or paying cannot raise the funds required from external sources. The policy is likely to appeal to shareholders who are more concerned with capital growth. So this shareholder is for the one who is more concerned with capital growth, because you can see the investment. Higher the investment, it will increase your shareholder value, right, in the future. And the short-term income. What is the short-term income? Dividend. Dividend is a short-term income if you're paying dividend. But if you're retaining it and investing it, you're going to have a long-term income, which is a capital growth. From capital growth, coming to drawbacks. Dividend payments are not totally unpredictable. We saw, as they depend on the investment choices. Yes, it depends on your investment choice, how much you're investing. Shareholders cannot rely on having any dividend income in a particular year. So in a particular year, they don't know how much dividend they are going to receive, the shareholder. They cannot rely on that. Many shareholders may be prepared to sacrifice dividends for a while in order for funds to be available for investment for growth. However, at some point, they may consider that IPing is well established enough to be able to maintain a consistent dividend policy as well as invest sufficient for future growth. So they want to say is, IPing is a well established company that they can also pay a constant dividend, and also they will have, after that also they will have sufficient funds left for investment. So that it could be considered that way also. So drawback. Coming to part B, use of dividend valuation model. Now you have to use a dividend valuation model to value each company. First, we are starting with Chithurst company. The valuation is this: 33 divided by 0.1. Your dividend you have to divide by cost of equity. So your dividend, if you see for Chithurst, same thing, same wise for others also. Okay, Chithurst, if you see the dividend for Chithurst, it is 33, like this, right? And it is 33 only. 33, 33, 33. Okay. So cost of equity is 11%. You have to divide it by cost of equity for all the others also. So it is 300 million. But according to the market capitalization, what was it? We'll see, according to market capitalization, it was 608 if you see here. 608. Not able to write. Okay. 608. It's giving a much higher figure. So we'll see, what is it? Chithurst smart capitalization of 608 is considerably in excess. Yes, you can see this in excess of valuation suggested by dividend valuation model. This may, why it is so high, you have to tell that also. This may suggest that investors have some positive fears whenever something is valued very highly, especially you see this tech industries and all, they are valued very highly because investors have some positive expectations about the company. So this is one of the reasons you can always mention whenever a company is valued very highly. When market capitalization is high compared to your valuation, why it is high? Number one reason, investors have positive expectations about their future, okay, about the company, and the lower cost of equity compared with other two companies suggest it is regarded as more stable investment. Lower cost of equity, positive. Investors positive expectations about company. Lower cost of equity, we'll see. Cost of equity. Lower cost of equity means it is less riskier. So if you see cost of equity 11%, 14, 12, so it is the lowest for Chithurst, which is good. Okay. Investors could also be valuing the company using earnings growth rather than dividend growth. Yes. However, the lower market capitalization compared with other two companies and the small increase in the share price suggests that investors have high expectations of long-term growth for Erdem and Iping Bank. Okay, see, what are they having? Saying lower market capitalization compared with the other two companies. Smaller increase in share price suggests that investors have high expectations of long-term growth for Erdem and Iping. So the share price which is increasing in Chithurst is small compared to Erdem and Iping, the other two companies. And also the market capitalization is lower for this company, Chithurst, compared to other two. That means this company has less expectations of having a long-term growth, but the other two companies are having more expectations, higher expectations. We'll see. Okay, just see the market capitalization. 608.104 to 1164. Iping is having the highest market capitalization and also highest increase in share price, whereas Chithurst is just having 1%, which is very less. So in the future, other two companies have a better chance of having a growth. That's what this raise are suggesting. Now let's go to the other one, the Earthham company. Here we just divided 33 because each year for the 4 years dividend was 33 only, dividend paid. 33, 33, 33, 33. That's why 33 divided by cost of equity. But when you come to Earthham, there's a growth. You have to find that growth first. You cannot just take here any dividend and divide by the cost of equity. That's why so many of workings for Earthham company. And same for Iping. Okay. So Earthham 1 year growth rate. First, you have to find the 1 year growth rate. Valuation using 1 year growth rate. First, you are using, how are you finding the 1 year growth rate? 48 divided by 44. If you see the dividend, yes. Check out the dividend for this and this last year's only. Okay, you have to take the latest, the recent years, which is 48. So you just want to see the increase, how much it increased from last year to this year, from 44 to 48. Only that increase you are finding out. That's why 48 divided by 44 minus 1. So increase is 9.1% is the growth. Using that growth, now you are valuing how? 48. You are taking the recent year's dividend into the growth. 1 plus the growth. Divide by cost of equity is 14% minus the growth. So this is the valuation. Now, that is just having the valuation of 1 year growth rate. Now, this is not a very accurate figure. Why? Because the growth rate for each year is different. So when you're having different years like that where the growth rate is different, it is better to use this method. 3-year growth rate. Now you're finding the 3 years growth rate. Based on 3 years growth rate, what is the valuation? So when it's for 3 years, it is this method. This is the method. 48 divided by 38 to the cube root of, okay, to the cube root. Why it is cube root? For 3 years. That's why. Or it is 48 divided by 38 to the power 1 over 3. Or cube root of 48 over 38. Same thing only. Because for 3 years. It might look 4 years, but it's for 3 years, okay? You have to take the latest and you have to take the oldest dividend. That's why 48 and 38. 38 is for 2002. Okay, I'll show. If you see to the dividend here, just see this 38 and this 48. It is the oldest and this is the latest. From here to here, it looks like it's 4 year, 2002, 3, 4 and 5. So don't do this mistake. From here to here is 1 year. From here to here is 1 year. From 2003 to 4 another year, and from 4 to 5 another year. So 1, 2, 3, 3 years. Okay. And 8.1, if you see, the growth is smaller than previous. Based on this, now you find still this will be same. The latest dividend divide into 1 plus growth divide by 14. Cost of equity will be same. Only the growth changed. Valuation reduced so much just by that change in growth. Now, if you see the market capitalization, What was the market capitalization of Eartham? It was 1000 something. Just check. 1042. 1042 is the market capitalization. So 1042 and this one. 1042 is the market capitalization. It's very near to this using the 1 year growth rate, but it's far away from this, right? One valuation using 3 years growth rate valuation is lower than market capitalization, but using 1 year it is higher. Earth companies market capitalization is closer to the valuation studied by the dividend growth model using 1 year growth rate in 2004 and 5 rather than 3 year growth rate between this and this. That's the same thing. We're just writing in sentence. This together with the recent increase in share price. Okay. Suggests that Eartham shareholders have an optimistic view of its ability to sustain the profit growth. Okay. So this because they're having a higher valuation compared to this, it shows, and also their increase in share price was something. I think it was 5%. I don't remember. Let's see. Yes, it is 5% only. So that increase and this increase using dividend valuation model suggest that shareholders have an optimistic view of its ability to sustain profit growth and has the dividend growth of the last 2 years. Although it is higher cost of equity, yes, than the other companies. If you see the cost of equity is 14%, whereas other two was 11 and 12. It is higher. So why higher cost of equity suggests that also you have to say. Suggest that there are more variable the risk of investing. It is talking about risk. Okay, cost of equity talks about risk. So it is more risky to invest in other. It indicates confidence in the director's strategy, including the investments they have made. They have made investments in that company. If you see investments increased. Okay, so how that investment increased, it suggests that it indicates confidence in the director's strategy. Confidence is there. Coming to Iping also same thing. 1 year growth rate valuation using and the 3 years growth rate. That you shall be able to calculate by now. Okay, based on this is the growth, this one and this one, which is very first one is near. Let's see what is right. The market capitalization of Iping is higher than it is suggested by dividend valuation model. But the dividend valuation model may not provide a realistic valuation because dividend payable are dependent on investment opportunities. Right? So it might not be a realistic valuation. The large increase in share price, 10%, compared with other two, suggests that Iping investors expect the investment to produce high long-term returns. See, higher increase in share price means what? Investors expect the investments to produce high long-term returns and hence are presumably satisfied with its dividend policy. So that's it for this question. Let us go to the marking scheme now. This is the marking scheme for the first part. 15 marks. 1 to 2 marks for the dividend policy for each company. Then 2 to 3 for the drawbacks for each company and calculations. Dividend payout ratios 1 mark per company and other calculations. That other calculations is up to you. You have to decide what calculation will be most suitable for this. One is dividend payout ratio, that's for sure. Coming to part B. Comments on valuation for each company, maximum 4 marks per company. That is for comments only. But 5 marks is for valuation calculations, okay? So make sure that you don't go wrong over there. So this is a very easy question. Provided that you know what is dividend payout ratio and you know how to work out your ratios, you just have to compare your ratios and talk about the dividend policies. Whether it is beneficial, how drawback it is, why this policy is not suitable and all. You just have to talk about all this. So that's it for this question. And if you see here, right, 27 is there. 27 I have already explained. So that video also you can see. So the next is 28 and 29. 2 more questions left. After that, we are done with acquisition and merger. Do take care and don't forget to subscribe to my channel. Take care.